now. Our focus is on Adani stocks. They have been under pressure. One stock we are focusing on now is Adani Wilmar, which is down 7% this week so far. Their 9 months FY24 volumes were at 8%, while the total inventory stood at 7,000 crores. To discuss how is the demand situation, how is business momentum, we have Angshu Mallick, the MD and CEO of Adani Wilmar, who's joining us now. Angshu, thanks a lot for joining in. As I mentioned, sir, in the 9 months of this year, in FY24, the volume growth was about 8%. So it's still in single digits. And in Q3, the volume was flat. Has demand come off quite a bit? Are you, worried that perhaps there could be a bit more of a slowdown before things pick up? What is your best guess of how the next couple of months could look like? And what is the volume growth that you're targeting for FY25?
See, the first 2 quarters were not so good, but the last quarter, this quarter, we are seeing good growth in terms of volume. We expect for the first time the branded edible oil business will have a double-digit growth, possibly after 4-5 years. The country is seeing higher consumption of edible oil. As a result, the overall business of edible oil has improved in terms of volume. Prices are low, so the consumptions are higher. Q4 should be also equally good in terms of volume growth. Going forward, the country is likely to consume more edible oil because in the stable prices, we see this consumption overall continuing at this. At least FY25 might be a little better than FY24.
Okay, so you said double-digit growth is what you're looking at for FY25, correct?
Yes, in edible oil for us.
In edible oil, okay. And can you tell me about the pricing situation? How is it right now? What is the expectation going forward?
See, the prices has been quite stable all through the last 4-5 months. So only its last 15-20 days that the prices have gone up. And that is because of the supply side constraints, particularly shipments not arriving on time. But these are all logistic issues, which I think by 15th of April, it should calm down. So looking forward, the supply chain should be normal as usual. And country has also produced good mustard crop. And so that will add from next week or so after Holi. So the supply chain will be very good.
All right. Hi, Mr. Mallick. Good morning. Nigel on this side. And you're sounding quite optimistic on business. So that's always a good thing to hear. Well, what about your market share? How do you see it panning out from here on?
This year, the market share has increased by almost 75 to 100 basis points. That is mainly because of our in-depth distribution, both in urban and rural.
Okay.
We have increased our number of dealers in the rural market. And today, surely our direct reach is more than 700,000 retail outlets. Indirect is around 2.1 million. So we are the largest distributed edible oil in the country, branded.
Yes.
So I think going forward, we should continue to do better.
All right. So you've increased market share by 75 to 100 basis points, which is good news. You want to give us an updated number, though? We have some numbers flashing on the screen, which is the overall and the branded business.
We should close at refined oil consumer pack. We should close around 19%, or maybe 19.1 by March. Next year, we are targeting a little higher. We hope to do that.
Okay. All right.
So branded market share, sir, you're saying is around 19.5%, right?
19% at least. 18.9 we were there last month. So I think March end should be better.
And your overall market share would be how much? Because, the numbers that we have is 12 and 20%. So I asked.
20% when you look at is roughly around the refined oil consumer price that we look at. But when it comes to mustard oil, we are the largest player in mustard oil, which is around 14.8%. So that makes us the largest branded edible oil player.
Okay, largest branded edible oil player. Got it. I also want to talk about the food and FMCG business. Over there, in 9 months of this year, you've seen a growth of 19%. So that's not bad. But tell me, how is the demand situation there? And what is the growth target that you're looking at for FY25?
See, the domestic growth has been, I would say, very good. We have been clocking at around 25-30%. What has not done well is the export of rice, particularly white rice and broken rice, which we did last year very well. So that has brought down the overall growth to 19%. Otherwise, domestic, if you see, rice is growing at around 45 to 50%. Wheat flour, we are doing at around 30-35%. Pulses also, we are growing at more than 25%. So the domestic consumption is quite robust, both urban and rural. And I would say here that our rural business is also doing well in terms of food and FMCG because these are essential products and required at every household. So in-depth distribution in smaller towns have helped us gain that market share also.
So would you want to grow this business further in terms of an overall percentage of your business? Currently, the food and FMCG business is just 10%. Over the next 3 to 4 years, how much do you want to take that up to?
See, you are right. We are pushing our food business. We are investing in food business. And there are a lot of capex that is coming up, both from the IPO side and from outside IPO also. And we feel the food and FMCG business should grow. Today, it's almost 10% of the volume, but going forward, it should be in the range of 15 to 18%. We will do around 900,000 tons this year, but next year we are planning to cross at least 1.2 million tons. So food business should grow fast. There is a lot of scope because the branded food, particularly the staples, when you look at sugar, spice, sugar, and then pulses and wheat, flour, rice, their branded ratio is smaller. So there is a lot of opportunity to grow and ramp it up.
Okay, all right. Mr. Mallick, what about margins? How do they pan out from here on? Give us a broad range that we should work with.
See, the margins have improved with stable prices. The brand has started doing that. There is a lot of premiumization that is happening. So earlier, our mass brands were selling more. Now, the Fortune brand is selling more. And there we have more margins. And going forward, I think the margin will improve. Number one. Two, as the volume increases, cost per ton reduces in distribution. And that is where we will have advantage. Processing cost goes down. Buying ability to buy at a lower price or at a discount price increases when the volume goes up. So overall, it looks like as the volume goes up in food and FMCG, and particularly when it is staples, it gives you quite a strong power to buy at a little better prices.
Okay, so from 3.9% of the past quarter, which has gradually improved, given the operating leverage, given the better mix that you're talking about, what should we work with? Around 4 to 5% or more for the coming year?
Can't say exactly how it is, but I can tell you one thing, that things are much better. It is improving. And whatever was past, surely we will be doing better. And that is an indication. Margins are also going to improve. With less volatility, the brands perform better. So we feel that the margins will improve going forward.
So the direction you have given us, that margins will improve. Final question from my end before we let you go. Adani and Wilmar, both of them hold roughly around 44.5 to around 44% stake, in the company. So you need to comply with that minimum public shareholding. How do you bring that down? Will you all be looking at a QIP? Which partner is going to be paring down their stake? If you could give us a broad timeline and a brief idea.
See, we have diluted so far 12% and we need to do another 13%. And we have to do that by February. So obviously we are working on it. We are looking at all the options and we'll see how we can dilute the balance 13% and make the best out of it.
Okay, all right. We'll leave it there, sir. Thank you very much for joining us. And it's a pleasure having you here on CNBC TV18. Good luck. Speak with you soon again.